Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Monday. It is December 13th. We're about halfway done with the month. We're getting into the holidays, but we're going to have a really interesting week, and I mean a very, very, very eventful week. The markets are up. They're not doing too bad. The future Dow is up substantially more than the near-term Dow, which is kind of odd because there's really no contracts in there. But so the Dow's not really up that much, but the S&P and the Nasdaq are up pretty good. The Russell's doing well. So far, the market is bullish. The bond market overnight is up a little bit, which is kind of odd because the market's up. That makes absolutely no sense whatsoever. Matter of fact, the bond market has been really strong lately, and it's kind of odd because there's really nothing to make it that strong this week unless the data, unless the O variant gets really bad or the Fed does a 180. I mean, there's really not a lot for the bond market to stay up. I mean, the Fed already told us they're going to start taking action, even more aggressive action, even after they found out about the big O. So I'm not exactly sure what their deal is, but with this choppy trading action, I believe the market's going to give out and we're going to go a little lower. We're currently short bonds. I'm just saying. We've got a busy week this week. We've got PPI, the Producers Price Index. Last week we have CPI, which was actually okay. This week we'll find out if producers' prices are being hit by the inflationary pressure and the supply chain bottlenecks. My favorite report of the week is going to be the retail sales. This gives us 2/3 of the economy. And we've got FOMC, which will give us direction and tell us what the Fed is finally doing. So I'm expecting the bond market to start getting a little muted tomorrow because it's nobody really knows what they're going to do. And we're taking a little bit of a gamble, but I believe the Fed is going to do what they said they were going to do. I think the numbers are going to be solid, and I think they're going to start taking action, probably a 1/4 of a basis point. But we'll see. We'll see. That's going to start happening later midweek. So midweek is a big day. Retail sales will give us a preview of what we should be expecting on the FOMC. They should be tied into each other because typically retail sales is a big report for the Fed. They understand that 2/3 of retail is consumer sentiment, retail sales, which is really the same thing. Then we've got housing permits, not really focused on this report too much. Jobless claims, not really focused on this report too much. These three reports I'm very focused on. Manufacturing index, industrial production, and PMI. That's going to tie into the PPI. So we're going to have a lot of Fed data, and most of this is going to impact the bond market and then have some impact on the stock market. Speaking of the stock market, I want to show you this. This is the put to call ratio, and the put to call ratio is getting bearish again. What I mean is it's getting cautious. And typically when we get above 1, we typically bounce back pretty hard. And that's telling me the market's actually going to move higher because this is not a level we see very often. And that's telling us the market is, that there were too many put buyers in comparison to call buyers last week. And when that happens, it turns over. But look at this. We went from grossly oversold to grossly overbought, and now, went from grossly overbought to grossly oversold, and now it looks like we're going to come back. But this market's been just all over the place. Just to show you the volatility, to go from 0.66 to 115 in just a few days, it takes some time. We've seen it here, but generally speaking, this is one hell of a volatile market. This is volatility. Let's talk about the S&P 500. The indices are expected to open higher. It looks like a V bounce, and it looks like we're going to make a higher high here. If you look at the QQQ, you will see that they are a little bit weaker, just a hair weaker, but we've already had 5 days above the 50-day moving average, and this has been a lot of volatility. But basically, we've seen just a lot of volatility here, and I'm expecting this price to go higher. If you look at the Russell, at the small caps, they have been stagnant, and I'm expecting the Russell to start picking up. This is kind of bearish. I'm a little concerned about the Russell, but keep in mind the correlation between the major indices and the Russell is very, very high, and we're coming off deep oversold levels here. So there's a good chance we're going to go higher and bonds are going to go lower. In terms of the heat map, this is a sector heat map. I want to show you what's hot right now. Notice technology. Tech, chips, they're not here right now. Information technology, -4 last week. Look at NASDAQ 100 down 7. So the heat is not going in there right now over the last month. The heat is going into building, utilities, defensive stocks, consumer staples. Remember I told you about a month ago that I'm expecting consumer staples and consumer discretionary to start switching places? So speculative stocks are lower. They're not that strong right now. And if you look at the worst sectors, you've got broadcast, TV, radio, mining hasn't been doing well, paper-related products. So it's a very interesting flow. And if you look at it on a 5-day basis, you'll see building, insurance, travelers, insurance. We're long travelers right now, just FYI. Hotels, MGM. I'm just saying this is the last 5 days, so you can see where the money's going to. But it is also showing that it is still going into semiconductors, but semiconductors are not leading. Building, insurance, real estate developer, hotels, retail. Anyway, semiconductors are not leading. You got shoes on here, but here you could see all the sectors that are leading right now. And here in the last 5 days, you could see all that have been lagging. Oil refining, mining, building, retail, wholesale, Northeast banks for whatever that's worth, the bond market, currencies. But the point is you could see where the weakness is and the strength here is. And the strength has been in blue chips, building, insurance, real estate development, oil exploration, and hotels. These are some of the biggest holders that we've been having in our portfolio over the last few weeks. By the way, I'm just saying, like travelers, like MGM, Mr. Cooper, that's also insurance. So the point is, we are in these sectors. Semiconductors, well, we've got NVIDIA. What can I tell you? It's still moving higher. So that's where the heat map is. This is where we should focus our strength right now. And this is where we should focus our weakness right now. Now, out of curiosity, I'm just curious, where in the world is healthcare? Healthcare. Life insurance, middle. So, okay, all right. Computer peripheral, nowhere near the top anymore. Transports, paper, finance. I'm not seeing healthcare, but I'm a little bearish on healthcare because healthcare rose when the O variant gave us a big fear, and now with it coming down, the healthcare sector is cooling off a bit. Now, let's look at StockFetcher for our sector heat map to see how fragmented things are right now. Technology, consumer discretionary, still top. Materials and industrial are fragmented. Consumer staples and utilities are not. Notice consumer staples not in 9th or 10th place, in middle ground now. So technology, consumer discretionary still continues to lead. But again, as I showed you on the heat map over the last 5 days, those have not building, top 100 stocks, insurance, real estate developers, oil, hotels. Oh, here's medical. Medical's right there. Medical's been doing okay. Retail, chemical, oil, and semiconductors. That's leaving yourself to these spots right here would probably be a good bet right now. So what do we expect for the next several days? Here's what I'm expecting. I think what's going to happen is we're going to, unless we see something really drastic with the put to call ratio being oversold. Remember, when it goes up, it's oversold. When it's here, it's overbought. I think the market is going to heat up and take out the high. I think NASDAQ is going to take out the high, and I think the Dow, let's look at the Dow, is going to actually overcome everything and become the strongest sector because it's looking really good right now. So I'm expecting higher prices for stocks, lower prices for bonds, and I'm expecting a lot of volatility this week. I mean, look at this. FOMC, we're going to have Fed policy. You've got retail sales. Just between now and Wednesday, we're going to have a lot of volatility. And I think Thursday, we've got the industrial reports. We're going to see how the bottlenecks in the supply chain is impacting the manufacturing and industrial stocks. On a consumer level, things are okay right now. They're as well as they could be. Also, we've got Redbook tomorrow, PPI tomorrow. We've got a lot of news. This is not a week to be a hero. Volatility is going to be really big. We're going to have a lot of unforeseeable moves. But I think the main flow will be higher because the market is set up really well. Put the call ratios oversold right now. So I'm expecting higher prices, but a lot of volatility. And again, this is where the heat map is. these are the stocks, these are the sectors that we're looking at right now. I'm short medical, healthcare, but otherwise I'm long most of these right now. Now, folks, I've got something very, very important before I let you go. Have you ever wondered why Wall Street always seems to be one step ahead of the average Joe trader? It's kind of funny. My friend's name is Joe, so whenever I see Joe, I always think about him. That's because the big firms have a ton of top secret trading strategies that give them an edge over everyone else. Duh, it's simple. Consistency, simple strategies that work, they deploy them over and over and over again. And while their methods are usually kept under lock and key, they don't talk about them. New Money Crew head trader Lance Ippolito, he's pulling back the curtain on Wall Street's best kept secret strategy. Lance is ready to reveal how tracking what he calls shadow blitzes can help spot which stocks might be ready to explode. Folks, I want you to get in on it. Click the link below to learn more about this powerful trading discovery. You need to learn about this. Follow the link below. Lance is a professional. He's an expert trader, and he'll teach you his best kept secret strategy. Follow the link below. Do not delay. And as always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of this market. Be the first to be notified when I post my next video for you. And tomorrow, oh boy, strongest sector, strongest stock, weakest sector, weakest stock. Do not miss out. And follow the link below. You want to check out what Lance has in store for you. Bye.